is the merits of bond investing. Dr. Satz.
Stockbrokers commonly insist that investors put 80% of their investable assets into stocks or stock funds and 20% into bonds or bond funds. The main reason for this is that stocks, in order to compensate for their higher risk, must outperform bonds over the long run. According to data compiled by the Bureau of Economic Analysis, the Bureau of Labor Statistics, Standard & Poor's, and as summarized in various papers by the Hoisington Investment Management Company, the overall stock premium from 1871, when the S&P 500 began, to 2009 was 3.5 percentage points. So for very long-term investors, such as young people just beginning their careers, it makes sense to have a high proportion of their assets in stocks. However, as will be shown next, this would not be the case for older investors because for certain shorter periods of time in the past, bonds have outperformed stocks. For instance, in the period from 1874 to 1894, the long-term treasury bond outperformed stocks by 0.9 percentage points compounded per annum. In the period from 1928 to 1938, the long-term bond outperformed stocks by 3.5 percentage points compounded per annum. And the period from 2001 to 2009, the long-term bond outperformed stocks by an amazing 7.16 percentage points compounded per annum. In Japan, from 1988 to 2008, Treasury bond returns exceeded those of common stocks by an even greater amount, 8.4 percentage points. What all these periods have in common is a deflationary environment with the economy not expanding much or even contracting. This is precisely the environment in which we now find ourselves. Currently, the U.S. economic system is over-leveraged and so must be leveraged. Whereas in 1875, the U.S. debt, both public and private, was 156.4% of GDP. In 2009, it was 369.2%. Also, whereas the average annual percent change in the M2 money stock from 1900 to 2009 has been 6.6%, it's now about 1%. The average velocity of money from 1900 to 2009 has been 1.67, which is about where it is now, but it's dropping fast. The real CPI-adjusted median new home price in 1985 dollars had been approximately $130,000 in 2006. Now it's $90,000. This means that the Federal Reserve monetary policy is and will continue to be ineffectual as efforts to spur growth are thwarted by declining asset prices, loan destruction, and adverse regulatory influences. The federal government fiscal policy is equally ineffective. The left has for many decades espoused the so-called Keynesian multiplier effect in which supposedly government expenditures can pump prime the economy. However, as logic proved a long time ago, and as empirical data now show definitively, there is no multiplier effect. Therefore, the $800 billion stimulus just adds to the overhead the populace will eventually have to pay off. This takes away money that could be used for the expansion of private businesses. In addition, there have been many hundreds of bank failures, which therefore inevitably curtails loans to the private sector. All this means that, unfortunately, taxes must necessarily rise, thereby further stunting our economic growth. Therefore, inflation will be quiescent. In this continuing contractionary and deflationary environment, bonds will continue to outperform stocks. The present PE ratio of stocks is about 19, whereas the historical mean is about 16. Therefore, stocks are expensive here. Most investors, particularly older ones, should therefore be 80% in bonds or thereabouts and 20% in stocks or thereabouts. Just the reverse of the usual stockbroker's advice. I'm Ronald W. Satz.